The first thing you need to understand about owning a bank is that the business does not do what most people think it does. The public imagines a bank as a fortress, a vast stone vault where depositors park their savings, and from which the bank carefully lends those savings out to borrowers, earning a modest spread in return. This is a comforting fiction. It is also a fundamental error. A bank does not lend out deposits in the way a normal business lends out inventory. When a bank approves a loan, it does not wait for a saver to deposit money before it can extend credit. Instead, it creates the money at the moment of lending. The banker types a number into a computer, and that number becomes a deposit in the borrower's account. In accounting terms, the loan is recorded as an asset on the bank's balance sheet. The deposit is recorded as a liability. Both appear at the same instant through accounting. This is not magic. It is double-entry bookkeeping, and it is the legal privilege that defines modern banking. The Bank of England itself has confirmed this, stating that the majority of money in the modern economy is created by commercial banks making loans. Physical cash accounts for less than 3% of the circulating money supply. The other 97% is commercial bank money, created by banks themselves through credit extension. This is the hidden profit machine. Once you understand it, you understand why owning a bank is not like owning any other business. The revenue model of a bank rests on 3 pillars, but the first and most important is the interest spread. The bank creates money at negligible marginal cost and lends it out at a positive rate of interest. The borrower repays the principal plus interest. The principal is extinguished from the money supply when the loan is repaid. The interest becomes the bank's revenue. This is the core transaction. It is why net interest margin is the single most important metric in banking. In the United Kingdom, major banks posted aggregate profits before tax of £31 billion in the first half of 2024. Net interest margins widened as deposit mixes stabilized and structural hedge yields pushed margins upward. But this is not a simple business of borrowing low and lending high. The bank does not first borrow the money it lends, it creates the money it lends. This means the interest it receives is not a spread on someone else's capital. It is a return on newly created purchasing power, though it is not pure profit. The bank still bears operating costs, credit losses, liquidity needs, regulatory charges, and funding costs. Yet it has no cost of goods sold in the traditional sense. Its raw material is its own bookkeeping. This is what economists call seigniorage, the profit from the creation of money. For centuries, seigniorage belonged to sovereigns who issued coinage. Now, a similar privilege sits largely with commercial banks, although in a different form. Banks do not earn the same seigniorage as a central bank because they must repay principal and they bear default risk, but they do earn special profits from the interest charged on credit they are legally allowed to create. In the UK, these special profits have been estimated at more than £20 billion annually, representing a substantial share of bank profits after provisions. This is not only a return on capital deployed, it is also a return on a legal privilege granted by the state and protected by the wider public balance sheet. The second pillar of bank revenue is fees. Banks charge for almost everything: account maintenance, overdrafts, late payments, loan origination, foreign exchange, wealth management, and advisory services. These fees are designed to be easy to forget and easy to trigger. They are also remarkably stable. Unlike interest income, which fluctuates with central bank rates, fee income is less sensitive to the economic cycle. Investment banking fees, in particular, have become a critical revenue stream for large institutions. Underwriting new issues, advising on mergers and acquisitions, managing client portfolios, and trading services generate substantial non-interest income. Fee-based revenues help banks diversify away from interest rate movements and reduce their dependence on monetary policy. But the third pillar, trading and proprietary investment, applies mainly to large universal or investment banks, not to every high street lender. These institutions maintain trading desks that speculate on currencies, bonds, commodities, and derivatives. They act as market makers, profiting from the spread between bid and ask prices. They take positions based on their own analysis and their own access to information. This is not banking in the traditional sense. It is a form of institutional gambling, but it is gambling with a significant edge because the bank sits inside the settlement system and has access to central bank liquidity facilities that ordinary businesses cannot use. For a retail bank, this pillar is small or absent, but for a global financial conglomerate, it can be a major profit center. The cost structure of a bank is surprisingly simple on the surface, but devastatingly complex underneath. The largest operating cost is labor. Banks employ armies of relationship managers, loan officers, risk analysts, compliance officers, traders, and lawyers. The second largest cost is technology. Banking is an information business, and information systems are expensive to build and maintain. The third cost is occupancy and physical infrastructure. Branches, headquarters, data centers, and cash handling facilities all require real estate and maintenance. But the true cost of banking is not found on the income statement, it is found on the balance sheet. Banks must hold capital against their assets. This is not an expense in the accounting sense, but it is an opportunity cost. Capital that is tied up in regulatory buffers cannot be deployed elsewhere. In the Basel III framework, banks must maintain minimum capital ratios, including a leverage ratio that limits the size of their balance sheet relative to their equity. These requirements do not necessarily reduce profitability, but they do constrain the bank's ability to expand. The real cost, however, is liquidity. Banks must hold enough high-quality liquid assets to survive a 30-day run on their funding. This was the lesson of the financial crisis, when even solvent banks faced collapse because they could not roll over their short-term liabilities. The cost of liquidity is not the interest paid on reserves, which is minimal. It is the foregone return on assets that could have been lent at higher yields but instead must be held in the form of government bonds or central bank reserves. This is the hidden tax on banking. Banks need central bank reserves and liquid assets because customers move money across banks, withdraw cash, and lose confidence during stress. A bank may create commercial bank money, but it cannot create central bank reserves for itself. That power belongs exclusively to the central bank. The capital intensity of banking is both enormous and deceptive. To start a bank, you need a license from the regulator. This is not easy to obtain. You need a credible business plan, a competent management team, and a significant amount of initial capital. In the UK, the Prudential Regulation Authority requires new banks to hold substantial capital buffers. But once the license is granted, the capital requirement becomes a multiplier, not a limit. A bank with £10 million of equity can create £100 million of loans, assuming a 10% capital ratio. This is the power of leverage. The bank does not need to raise deposits to fund those loans. It creates the deposits when it makes the loans. The main constraints are capital, liquidity, regulation, borrower demand, credit quality, and profitability. Capital can be increased through retained earnings, which themselves come from the lending. This is the virtuous cycle of banking. The more you lend, the more you earn. The more you earn, the more capital you have. The more capital you have, the more you can lend. In aggregate, the banking system is not constrained by capital in the simple textbook way. But capital still matters because losses destroy equity. Regulators impose capital ratios, and shareholders care about return on equity. Capital does not work like a simple reserve limit, but it still shapes the bank's ability to survive losses, satisfy regulators, and expand its balance sheet. This is why large banks are so attractive to investors. They are leveraged machines that generate high returns on equity, not because they are efficient, but because they create the money they lend. In 2024, NatWest reported a return on tangible equity of 17.5%. Lloyd's reported a net interest margin of 2.95%. These are not extraordinary margins. They are extraordinary returns on a capital base that is a fraction of the assets. The risks of owning a bank are unlike the risks of any other business. The first risk is credit risk. Borrowers default. When they do, the bank loses the principal. This loss reduces capital. If losses accumulate, the bank becomes insolvent. This is not a theoretical risk. It is the reason banks fail. The second risk is liquidity risk. Banks fund long-term assets, like mortgages, with short-term liabilities, like deposits. If depositors lose confidence and withdraw their money, the bank must sell assets to meet the demand. If the assets have fallen in value, the bank takes a loss. If the loss is large enough, the bank becomes insolvent. This is what happened to Northern Rock. The third risk is interest rate risk. Banks borrow short and lend long. When central banks raise rates, the cost of funding increases faster than the yield on existing loans. This squeezes the net interest margin. Silicon Valley Bank is a recent and instructive case. It held long-term government bonds funded by short-term, uninsured deposits. When interest rates rose, the bonds lost value. When depositors panicked, the bank had to sell bonds at a loss, wiping out its capital. The bank appeared solvent before the run, but the sudden demand for cash forced losses into the open. This illustrates the distinction between insolvency and illiquidity. A bank can fail even though it creates deposits because it cannot create capital for itself, and it cannot create central bank reserves for itself. If borrowers default, the bank's assets fall. If depositors and other banks demand settlement, the bank needs liquidity. This is the cleanest way to explain why banks are powerful but fragile. The fourth risk is regulatory risk. Governments can change the rules. They can raise capital requirements. They can limit fee income. They can impose new taxes on bank profits. They can even break up large banks. The fifth risk is reputational risk. Banking is a business of trust. When trust is broken, the business collapses. This is what happened to Lehman Brothers. The firm was heavily leveraged, but the immediate cause of its failure was a loss of confidence that made it impossible to roll over its short-term funding. The sixth risk is systemic risk. Banks are interconnected. When one bank fails, it can bring down others. This is why central banks act as lenders of last resort. They create money to prevent the system from collapsing. But this guarantee is also a risk. It creates moral hazard. Banks take excessive risks because they know they will be bailed out. This is the paradox of banking. The state guarantees the deposits. The state provides the liquidity. The state underwrites the system. But the state does not control the money creation. That privilege belongs to the banks. So why do wealthy people, institutions, and family offices want to own banks? The first reason is the cash flow. Banking generates steady, recurring income from interest and fees. The second reason is the leverage. A bank can earn high returns on equity because it can create the money it lends. The third reason is the regulatory moat. Banking is heavily regulated, which makes it difficult for new entrants to compete. The fourth reason is the information advantage. Banks see the flow of money in the economy. They know who is borrowing and who is saving. They know which industries are growing and which are contracting. This information is valuable. The fifth reason is the strategic control. Owning a bank gives you access to the payment system. It gives you a seat at the table when governments borrow. It gives you influence over the allocation of credit. This is not just about money. It is about power. Ordinary people see a bank as a place to store their savings. Owners see a license to create money. Ordinary people see interest as the cost of borrowing. Owners see interest as the profit from creation. Ordinary people see regulation as a burden. Owners see regulation as a barrier to entry. This is the difference between the surface and the machine. The conclusion is this: owning a bank is not about having a product. It is about controlling a system of cash flows, risks, contracts, assets, people, laws, and incentives. The bank does not exist to serve depositors. It exists to create money and to profit from that creation. Depositors provide the stability that allows the bank to operate, but the public story about deposits funding loans is the fiction. The loans are funded by the bank's own bookkeeping. This is the hidden truth of banking. It is why banks are so profitable. It is why they are so powerful. And it is why they are so fragile. The system depends on trust. When trust is broken, the money disappears. Not because it was stolen, but because it was never there in the first place. It was only a number in a computer. And numbers can be erased. You sell trust. You create credit. You manage liquidity. You live on confidence. And when confidence breaks, the most powerful business in capitalism becomes one of the most fragile. This is the economics of owning a bank.